And we may still have some folks joining us. Good morning, everyone. Welcome on a very snowy Friday morning. It's just a little after 10. We're going to get started with this morning's session of our Life Wealth Speaker Series. We may have people joining us through the course of the presentation. It is a pleasure to welcome Craig Basinger. And I was saying to Craig, I woke up this morning, looked out the window, and I thought, oh, well, I fondly reminisced actually about it's a snow day. And, you know, a snow day used to mean best and a bonus on a Friday. You get to work from home in comfy clothes. Maybe I'd call my mom or dad and, you know, get to my desk and hammer away and have a really productive day. And yet now that's Groundhog Day because we've been doing kind of a snow day thing for well, you know, about a year. So I hope this morning finds you well if you did have to go out and shovel. Welcome to our session of Coffee with the CIO. And that's what's going to make today special. Other than the power outage, and we had about 8:30 a.m. I don't know if any of you did. So, you know, that made for an interesting morning. But we are having a special guest this morning and coffee with Craig Basinger, our Chief Investment Officer at Richardson Wealth. And Craig, welcome back. Come on and join us. It's nice to have you back again.
Great, thanks, Bev. And thanks for having me.
Yeah, a pleasure. Craig, as many of you know, heads up our Connected Wealth team. And this is a team that provides us with insight and analysis and assessment, help on the markets, the economy, portfolio construction, really, really valuable. And we've been working a lot together in terms of investment strategy and investment proposals. So Craig, thanks to all of you working hard from home over these many months as well. Last time you joined us was last May, and it was early on in the pandemic, and you had presented the talk at the time called Looking Across the Chasm. You know, what could we expect from the unknown and the uncertainty? And you certainly, you know, made some good calls. Here we have arrived, I think, across the chasm. And that was a coffee with the CIO session as well. A funny story on that, I think you don't mind if I share. At the time, you were living in the downtown core, and your neighbor was Mayor John Tory in the condo building that you lived in. And was it he or his wife was in lockdown at the quarantine at the time?
He was, because he'd just come back from the UK early on in the pandemic, yeah.
It was very early in the pandemic, and as I recall, you were, was there a Starbucks in your building? So yeah, coffee ended up at the door for Mayor Tory.
I had a part-time gig of delivering coffee for a while, yes.
And now you've joined the exodus from downtown Toronto. You're living in the burbs, if you will, shoveling snow with the rest of us. So how's that going?
Very good. I call it the suburbs, although I think since I'm south of Eglinton, most people around here don't, but it's certainly more of a neighborhood versus condo living. So that has pros and cons. The obvious con is that we're starting to shovel a lot more.
Yeah.
You know, I think but the pros, obviously, a little bit more space certainly helps. And yeah, fewer protests in front of this building than my last.
Yeah. What were the protests about?
They're every weekend. It's, I think, because we still get the notifications, I think last weekend was hugs over masks. So it's the anti-maskers protesting the social distancing rules and not minding to come by the residence of the mayor.
Okay, well, poor mayor.
Yeah.
Well, welcome to your peaceful existence, and thanks for joining us again this morning. Today, you're going to talk to us or share with us your thoughts and the team's thoughts on sort of the outlook for where we're at and the outlook ahead at a time when we're in a different place, where we're now more interested in vaccines and what that might mean. So appreciate if you want to take it away and let's go. And am I staying on camera, or are you going on camera, or?
Hopefully you should be able to see the presentation at this point. So
got it? Yeah.
Because we're panelists, you and I, Bev, we're going to stay in the little box in the corner. You can mute your line if you want, though. It's up to you.
Will do.
You never know where a dog will bark or a package will be delivered.
Right. Will do. I'll turn it over to you. Thanks, Craig.
Perfect. Thanks, Beth. And yeah, the funds of working from home. And yeah, I think I think the last time we did this with your clients, it was sort of looking across the chasm, and it was, really talking about the fact that, we knew this big hole in the economy and the economic data was going to come, and then how would the market react to that? And, I think last year had, I would say last year had so much that it's even just not even a point in counting. I mean, it was just a year of unprecedented everything. And obviously the pandemic is the root cause or trigger for a lot of them. But I think people have had to redefine what the economy looks like, how they operate in it. And I'll be honest, I mean, it's hard to say that we're actually across the chasm right now, but we kind of are. And it's not because we got to the other side. It's because our economy adapted. Like, it is amazing how resilient so many businesses are and how they pivoted in this environment. And it's now at the point where, yeah, there's really concentrated pockets of pain because there are industries that you just can't socially distance and operate. But beyond that, the economy is in a pretty good shape. And then you throw on top of that I our investor relations person for our parent company sent me an email because he had to write a quick blurb in the annual report, and it was, just, it's kind of filler. It goes in an annual report. It's out 4 months after the beginning of the year, but somebody has to write something. So he shared with me what they had written at the beginning of last year, and it essentially said, you know, very high level of accommodative policy from central banks. And, that was at the beginning of last year, so before the pandemic. And I think what we've really redefined is what accommodative can mean with what's going on today. And as with central banks and governments try and bridge the economy through the rest of this pandemic. But it is encouraging that we're getting closer and closer to the other side, which is, I think, very positive. The title is a little mania to start 2021 because it, yeah, high unemployment, things getting better, vaccines coming along, but there has been a certain level of speculative mania in certain pockets of this market that I've been in this industry for 25 years, managing money, and it is reminiscent of a time long ago in the early years of my career in the early 90s in certain pockets, some of the speculation, and it's not necessarily an unhealthy thing, but it's certainly makes things a lot more interesting. So yeah, we are off to a strong start in 2021. This market continued where it left off the tail end of 2020. It had strong upward momentum. Obviously the resolution of the presidency side of things, who was going to lead the U.S. Was a big positive. I don't know if it's a positive long term. I tend not to try and guess the longer term impacts of different political leaders and their platforms. But I would say the one thing that we do know is markets really dislike uncertainty. And as you strike these things off the list, you remove uncertainty and things become better from a market perspective. And really, if you're looking back and, at the bear market in early 2020 due to the pandemic, it wasn't just because of the pandemic. It was the amount of uncertainty. Like, in February and March, we just did not know the path this pandemic would take, the impact on the economy, the mortality rate, how infectious it was. And don't get me wrong, like, a lot of that news ended up being bad, being worse than people had expected. I still remember early on, people were comparing, hey, well, this is what SARS did, and here's a playbook with Ebola. And little did we know, we all had to go back to the Spanish flu to find out something that actually looks similar to this. But even though a lot of the news is bad, it removes uncertainty. And from a market perspective, it can handle bad news, cannot handle uncertainty. And I think we've crossed a lot of those things off over the last year. And I think that's what's been helping drive asset prices higher. And now, of course, we have, the vaccines that are starting to be rolled out. which certainly is positive. But we do have many bubbles. There's been so much accommodative monetary policy thrown at this market. It's not a very it's not a very tactical tool. It's very sort of broad-based, and it does flow into areas that they probably didn't want it to, but it does. And that's, I think, why we're starting to see some, mini bubbles, whether it's in crypto and, obviously the firm that I'm affiliated with as well as Purpose, and they just launched the first crypto ETF yesterday. It was the largest ETF launch in the history of Canada from a trading perspective.
Well, congratulations on that. Off with a bang, I guess.
And I mean, look at all the money they've been saving on because they usually advertise on Air Canada. It's the most thing ever.
Right. Some thief is always in the seat pocket in front of you. Yeah.
It's like, I just want to watch my movie. But it's been, I wonder what the next round of commercials will look like. But yeah, so there's many pockets. I mean, the crypto craze is a little bit of a mini bubble. Clean tech, there's thematic bubbles out there we wrote about last week in our market ethos. But that being said, they're all pretty small. They're not systematic. Housing, that was a systematic bubble because it rippled through the rest of the economy. These are pretty small in the big scheme of things, which is reason not to worry about them too much, but certainly entertaining to watch.
Well, entertaining, but I hope people are also taking some lessons away from some of the things that are happening, because nothing has irritated me more than watching the Super Bowl to Questrade commercial after Questrade commercial. And I just after that, the big GameStop game shop thing blew up. GameStop, yeah. And I just thought, what, this combination of inexperienced investors and easy access, cheap access to the market with these $5 trades at Robinhood and very little regulation is such a recipe for disaster. And we're seeing that with the volatility it's creating, with social media influence. It's really been quite a phenomenon that's just come up so quickly.
It does have some echoes of previous speculative little bubbles, even to the late 90s. Not to the same degree, because this is sort of a crowdsourced kind of behavior, which is a little bit different. The world changes, people's behaviors changes. I get it. I would say one of the takeaways I would share is, I mean, GameStop was a very unique situation that had a massive number of shorts, had a sort of a confluence of factors. But it was quite interesting because this group on Reddit tried it on a few other different companies, and it did impact it. It impacted Afria here in Canada. Right. It impacted AMC,
theaters.
Not the makers of Walking Dead, but the theaters, yes. And I mean, clearly troubled businesses, and that didn't matter. The fundamentals didn't matter here at all. But it was just a flow of money coming into certain names. But it was interesting, I found, because they also tried it with Nokia, and it budged for half a day and then went back to where it was before. They tried it in the silver market, and it barely moved. And the real crux of it is, nobody's going to say the market's efficient. It isn't. But there's various degrees of efficiency and various degrees of liquidity. And I think what happened was GameStop, very narrowly held by a few investors, strange short position on it. Not strange, I mean, it made sense, but it was a very unique situation. When they tried it on increasingly bigger companies, the impact was less and less. And when they tried it on Nokia, that has a global investor base, and pushed the price up, I guarantee you, as soon as people woke up in Finland or in Europe, where the majority of the shareholders are, they said, you want to give me $7 for my shares in Nokia, you can have them all. And that quickly brought it back to normal, and it's
stopped it in its tracks.
Yeah. And I think and silver is such a massive market that it just, it barely blinked. So certainly entertaining, but keep in mind, these were small companies to begin with that got pushed around by a sudden wave of investors. And the smaller the company, the less liquid, the more inefficient it does tend to be. And that's what I think contributed to it as well. But it's certainly made things interesting. Sorry, go ahead.
Yeah. Should we just mention, Craig, if people have questions while we're going through the content, there's a chat function, or are we using chat or questions and answers?
Yeah, you should. So there's two options. There's Q&A and chat. I'll take a look at both of them when
We'll watch them too.
yeah, when we get closer to the end, I'll sort of flip through them. But yeah, feel free to just jump in there, type a question, and we'll sort of we'll round those out at the end. Yeah, sorry, I forgot to mention that at the
Sounds
beginning.
good. Okay. Carry on.
Yeah, but so I mean, beyond the sort of little speculative little bits of mania in the corner, this year has been driven by a whole amount of stimulus that is relatively unprecedented. And don't get me wrong, like it's been the right thing to do. I mean, you had people, a whole bunch of people weren't going to be working. Like something had to be done. They were either going to be on unemployment or pick up a different kind of check. So I think the decision is the right one. The impact on the market has been very interesting, and I think there's going to be longer term ramifications, which I'll touch on later. But it's been the right thing to do, and it certainly has inflated asset prices. That includes real estate, that includes equity markets, that includes commodity prices. And I think what's more and more interesting now is this chart on the bottom left, which is the 10-year yields in Canada and the US. And so, I mean, the central banks, the Bank of Canada sets the very short-term overnight rates. So they're really short-term interest rates, and that's what impacts your, borrowing costs short term and that type of thing. But the economy is more driven on longer term yields, and the government has less influence over those. That's more driven by economic data. And the fact is, these bond yields have started to rise. And so far, the market's been fine with that, I think, because they're coming off such a low base. But as these yields rise, this is the opposite of liquidity injections into the market. This is essentially taking liquidity out of the market. And I think this market has become very influenced by liquidity with what the central banks did on quantitative easing and bond buying and pushing yields down to where they were. And I think at some point the market's going to react negatively to these higher yields. So far it hasn't. I think the key will be how quickly they rise and how far they rise. And of course, we've also had a rise in Canadian dollar, which is nice to see, depending on, it'll make your trips to the US much cheaper once you're allowed to go.
Yeah. One thing, Craig, I just want to ask, on the right side of the slide, just over this Canadian dollar slide, just sort of a gray box now.
Oh, sorry. Yeah, that's.
There we go. Perfect. Thanks. The reveal. Yeah, I remember when we used to watch foreign currency or US dollar rates because, we were planning our next trip somewhere. So that we don't quite have to watch as closely for that reason anyways.
No, that's right. Yeah. And sorry, every once in a while I opened the chat window and that's what was sitting in front of the presentation. So complain to my Cisco friends at some point. Oh, sorry, went too many. So yeah, on the pandemic, and again, like I'm sure everyone who watches the news knows what's going on here locally. We tend to take a bigger picture, sort of globally, what this looks like, because obviously that's what impacts markets more than just what's happening in sort of Ontario and when we can get our haircut again, etc. So it's largely good news. I mean, there's no question. This chart on the top left, this is active cases, those little gray bars. So this is the people who are currently afflicted with COVID-19. And we had a massive spike that we call it the fourth wave. We had the first one that was predominantly in China and Italy. We had the second one, which was in pockets of the US. Then we had the third one that was broader based in the US, Brazil, Russia. And then we had this fourth one that was pretty much everywhere. It's coming back down pretty quickly now, which is encouraging. There are new variants. Obviously, that's a bit of a ripple into it, but the direction down is very positive. This is not unexpected. The fact is, when a whole bunch of people do get infected, like we saw in that fourth wave, because most people recover in a week or 2 weeks, that number starts to come back down pretty quickly. But still, it's don't know if there's going to be another wave or not. That's hard to say. The positive news, obviously, is on the vaccine side. It's positive from a number of different perspectives. The efficacy rate is better than a lot of people expected going in. And the rollout, I get it. Like the media, and I pick making fun of the media here, but they will report any negative news that they can. So yes, there have been hiccups in rolling out a vaccine to the entire population. I mean, I'm not sure why anybody would think there wouldn't be. But the fact is, it's progressing, and this data here, 128 million people globally. This is from sort of a little over a week ago. It is well north of 150, 160 million now. It is moving along, and a lot of the disruptions were for a lot of the companies actually taking down production so that they could increase capacity. So again, positive all around. It's coming, and it's important because, like I said at the beginning, a whole bunch of this economy has pivoted. Big parts of this company have pivoted, or this economy have pivoted, except there are areas that just can't, and that's the missing component. So, like I said, the global economy has done a fabulous job in sort of adjusting to this kind of world where we're socially distanced, working from home, doing other things, and I think that's a huge a huge testament to just the human race. Like, we adapt as a society, we adapt to big issues, and this has obviously been a massive issue, and we've largely adapted, some better, some worse, but the fact is the economy adjusted and adapted really well, and that's been pretty encouraging. Now, of course, the issue is, this chart on the bottom left, the US lost 20 million jobs. We lost almost 3 million. We almost got back to only being down 500,000 jobs. Now it tapered off a little bit. The US came back. It's now down 10 million jobs from pre-pandemic levels. To close that gap is the vaccine, because that gap is almost 100% in the industries that cannot operate under a socially distanced world.
So the service industries and entertainment and hospitality, those kinds of things.
Yeah, parts of travel as well. So and we all know we all know what industries they are, because they're missing at the moment, and we're all sort of wrestling with.
And we're missing them.
Yeah, 100%. So.
Craig, I want to just highlight to our audience and our friends here the shape that keeps coming up, and it takes me back when we were talking last May across the chasm, and there was at that point the uncertainty around how this would all play out. I mean, we knew nothing really at the time, and you put things, and many people, but put things in perspective of what shape would this be, a V, like a V recovery? Would it be a W? Would it be an L, as in no recovery? And you guys got onto the inverse radical.
Yeah, the flipped radical.
Flipped radical, yes. And that, if you can just trace that, I mean, I'm seeing it over and over again, is essentially that was the right call. A sharp, obviously, bottom fell out, and then a fairly sharp recovery initially, and then it's just staging out with that gap of the recovery of the service industry, and the vaccine being really what we need to get everybody out and about again.
Yeah. No, that's everybody's been throwing letters at this quote unquote recession, and I'm not even sure it was a recession, but I'll touch on that in a sec. But yeah, so everybody's been throwing letters, and that was ours. I think somebody else called it a backwards check mark. I mean, everybody gets creative in this.
Creativity, but it was well founded.
Yeah,
it was a good idea. Yeah.
Thank you. Coming up with a tagline is always one of the toughest parts. Well, maybe the toughest part's getting it right first, but
yeah.
So we've had a pretty phenomenal, and even parts of the industries that we thought would run into trouble have adapted really well. So I think that's pretty neat and pretty impressive. Of course, now we don't know what happens even when those industries do open up, because it's quite possible there's more pain out there than we know about. It's just being sort of glossed over because of what's going on. But it's there are a number of encouraging aspects, and this chart on the bottom right, and this is where I put quotes around this recession. This is the trend in global bankruptcies. It's from the IMF, starting at the right before you rolling into a recession. And, not too surprising. And sorry, I clipped the legend there. That black line in that chart on the bottom right is the average of the last six recessions. But really what you're looking at here is, the orange line, okay, financial crisis. Yeah, I mean, it's credit driven, pile of bankruptcies there. So, onset of the recession and then boom, bankruptcies spike up. But the fact is bankruptcies trend higher in all recessions. That they do. That's one of the characteristics of a recession. Obviously, these companies going bankrupt, but not this one. And this is where it's quite interesting. And, the trend in bankruptcies has actually gone down. And part of that is the central bank response, because they've put so much liquidity into the bond market that any company with even a heartbeat that's big enough to go into the bond market, because small, like, a hairdresser can't go into the bond market, obviously, because they're too small. But if you're a big enough company to go into the bond market, even if your business is in terrible shape, there is so much money in that, because of what the central banks have been doing, being injected into that space, that companies are able to raise money, and that's been able to sort of stave off bankruptcies, which is, potentially very impressive and very good. But the downside of it is you just kind of wonder longer term, is it the right thing? Because are some business models that should be taken out not being taken out?
Sort of like an artificial way to sustain things, just, everybody gets saved at this point. Unfortunately, not the hairdressers, but I'm thinking of the expression, keep them afloat. A couple weeks ago in our Life Well speaker series, we had a look at the future of travel. One of our other guests is a veteran travel agency and travel agent professional. And we talked about, for example, people were asking, are these companies viable? What about Carnival Cruises, for example? They don't have any ships out there right now. But they have, I know Carnival has come to the bond market for $800 or $900 million. I mean, the credit is available to them. The rates are low. The central banks are buying these bonds. So it does seem to be keeping things floating until they're not, or until we see what happens, I guess.
Yeah, and as sort of as a part economist, I understand both sides of it. So you can make the argument that this is an exogenous shock to the economy. It is artificial. I'm not saying the pandemic's artificial, but it's like it's not an economic recession. This is like this is a shock-driven contraction, in which case you bridge everything you can, because when things get back to normal, those businesses will be fine. But on the flip side, because I like the Austrian economists the most. If there's any economics people out there, they might know what I mean. But
is that the one-armed economist?
No, not the one-armed ones. No.
Oh.
But the Austrian economics is a big fan of letting the forest burn down, because if you don't, then what you're going to create is a bigger problem down the road. And so there is the risk of that as well. I'm probably somewhere in the middle. Like, I don't think this is like what Japan did and sort of getting zombie companies roaming around that impacted their economy for decades. But I think it's a bit of a risk that it's going on, and it'll be interesting what happens, I think, out the other side when the stimulus does start to come off, because you're right, like Carnival can go out and raise money. Like, if we, anybody can raise money. It's kind of a little crazy on that side, but but I understand the methodology behind it. And the good news is the economy is coming back, and people are going to be on riding cruises again. And in fact, Carnival does have boats there. It would probably shock everyone if they knew how many people were actually on cruises today, right now. But we live in Canada, so we're sheltered. Yeah.
Well, this is the problem. They banned cruise ships in Canadian waters for another year. So nobody, Carnival, Norwegian, Royal, none of them can go up to Alaska, which was devastating. But anyways, nonetheless, the economy, the recovery is better than we'd expect, really.
Yeah, 100%. And you know what? And the other good news is it would be really hard for this economy to get sideswiped as this year progresses. So we're going to start rolling into like easy comparables from last year that are going to make the economic data still look quite good for quite some time. And I think that trend certainly continues. So 2021, from an economic perspective, there is almost nothing to worry about in my view. Where it does get a bit worrisome is when you go back to the markets. So, and it's not as simple as 2020 was a terrible year for the economy, but a great year for markets. Is 2021 going to be the reverse of that? But back to those rising bond yields, this market has been inflated, held up, whatever you want to call it, given a shot in the arm, boosted, whatever you want to call it, because of low yields and low interest rates. And while the central banks are not going to be changing the short end of the curve, like the short-term interest rates, those are going to be held down potentially even longer than they should be, but that's, again, debatable. But longer-term bond yields are starting to react to, of all things, what we just talked about. The economy is doing better and better. The vaccines coming, parts of the economy are going to open up, and that is pushing higher yields further out on the yield curve higher. And that has an impact. That is the opposite of liquidity, like I said. And because this is a very liquidity-driven market from a valuation perspective, puts things at risk. And that certainly has the potential to at least reverse some of the sort of mega trends over the last decade. And, some of that is the growth or the mega caps from that side to value. One area that we've been talking a lot about is on the sort of cyclical yield side. And this really comes down to the fact that even you can compare two companies that both pay a dividend of, say, 3%. One of them will react materially to changes in bond yields. In other words, if bond yields go up, their price will fall. If bond yields go down, their price will rise. Others react much less. And I think for dividend investors, that's going to become a key thematic within dividend portfolios as these bond yields rise over the near term. But I think one of the big questions that we get quite often in these is sort of on the inflation side, and what does it all mean down the road? And of course, inflation is something that everybody's been talking about for years and years, and just never seems to show up. That's my career. Inflation just goes down.
When will we get inflation? I mean, we've been asking for a decade, really.
I know, and hoping. Everybody wants to now's the time, and it's everybody thought coming out of the 2008, now is the time. Crisis. Because you had monetary policy, you had the equivalent of money printing, but it didn't happen. And one of the reasons it didn't happen following 2008, 2009 was, one, it was a credit-driven recession, and that is very deflationary because capital had to be restored after that. And the other aspect was back then, so quantitative easing is when the government basically goes into the bond market and buys bonds. And what they're doing is they're buying them from somebody, and it essentially is injecting liquidity and money into the bond market, which then ripples through the economy.
And we had rounds of that, QE2, QE3, it went on and on.
It did, yes, but it wasn't inflationary because what was the mechanism? They were essentially buying many of the bonds directly from banks, and banks were not then going out and lending out that money. I think for a couple of different reasons. One, I don't think there was much demand for it, but the other reason was the investor base had changed because so many banks got in trouble during the financial crisis. If you go back and if you were an analyst or portfolio manager looking at a bank in 2005, you would look at things like return on equity. How fast is it growing? If you looked at a bank in 2011, 2012, all you were looking at is how safe is the capital ratios of this bank? What is their tier one capital? And what the market was saying is, we don't care if you grow or not, Royal Bank, Bank of Montreal, Citigroup. What we care about is, are you stable because of what happened in 2008? And as a result, many of the banks, with this liquidity, instead of lending it out and putting money back into the economy, and again, it's because there wasn't that much demand for it anyway, they decided just to make their balance sheets more bulletproof. So that QE was kind of money printing, but the bank's behavior was the opposite of money printing, so it sort of negated it.
And that it was frustrating because the banks tightened up on credit big time. I mean, that's when I sort of became more aware of alternate lending and, you know, other avenues, because the banks, I mean, they're already tough to get money out of, but they were just like, no, thanks, we want to keep what we have. So
yeah, and that did open the door for a lot of alternative lenders to fill in that gap that the banks didn't want to be involved with anywhere, for sure. The other aspect was at the same time back then, following 08, 09, is you had fiscal austerity. You had governments actually still being fiscally prudent.
oh God, yeah, I remember that now.
I mean, Europe was there. Europe was cutting back on spending, like they were punishing Greece and other countries for spending too much.
The pigs and yeah.
Yeah. So that's why in my mind, the inflation didn't take hold. But that would have been sort of, let's say there's a cyclical aspect to inflation, and that would have been a cyclical uptick that didn't, took part a little bit, but then petered out. It's a little bit different today because what we're seeing today is actually they've taken the banks out of the equation. So essentially what's happening today is the government's spending the money, whether it's sending checks to people or the programs to support businesses and individuals, which again, I'm not saying there's anything wrong with that. It's kind of what we needed to do. And what's happening is at the same time, they're issuing more and more bonds, treasury bonds in the US, government of Canada bonds up here. And simultaneously, the central banks are also in the market buying treasuries and buying government of Canada bonds. Bank Canada is doing it as well. And so what we're essentially doing is we're monetizing the deficit spending of the government, which again, is absolutely the right thing to do. But that is inflationary. What's holding it back right now is the fact that we still have really high unemployment, which is keeping it down a little bit. And we've got this rent phenomenon, which is a big component of consumer price basket, and rents have come down considerably. So you've got those sort of things that are holding it back. But I think what we're going to see is we're going to see an cyclical uptick in inflation in the next few quarters to a year. It's not going to be a runaway inflation, and because inflation longer term, like that's sort of shorter term cyclical. Longer term on the secular side, there's three things that have been holding inflation down, and it's technology, it's demographics, and it's globalization. And those are what really have created this downward inflationary environment for the last, 10, 15, 20 years. But interestingly, if you look out a couple of years, it starts to change a little bit. So technology will always be deflationary just because it helps productivity.
Look, yeah, all the advances, we've seen them in the last year more than any time, really, I suppose.
Yeah, because we've been forced to learn them, like how we've learned how to do a WebEx. Yeah. And I mean, autonomous cars will come and stuff like that. So that's always, going to put downward pressure on inflation. But the other two get a little bit more interesting. So globalization really accelerated when China was led into the World Trade Organization, and continued to grow at a very massive rate for sort of 20 years. But the rate of change, rate of growth in globalization, global trade has slowed down. And I think, there might be some ramifications from this pandemic and people sort of, changing their supply chains and making them more resilient, which means bringing them closer to home. That being said, most of the businesses that could have easily been moved anywhere to a lower cost environment have been moved. So I think that globalization trend is going to start to peter out on putting downward pressure on inflation. And if you're wondering where that shows up, I mean, if you look at how much of a refrigerator you can get for a certain amount of dollars today versus 20 years ago, that's deflation. Like we can get much better stuff today than we could before. That's deflationary. But that's starting to slow down. And the other aspect on the demographics, I think, is going to be interesting because it's just starting to sort of round the corner, and demographics would move really slow. So, it's sort of like a glacier, but
glaciers don't stop.
That's right. Yeah. And what happens around the middle of this decade is something I think quite interesting. And it's, the baby boomers retiring has been put downward pressure on inflation because there's just more and more savers versus borrowers. But
more money in the system, more supply than demand. And
exactly. But what happens around the middle of this year is the millennials get into really the large cohort of millennials increasingly get into that household formation stage where they're, I'm not saying they're still living at home now. Well, they probably are, but but they get into that household formation stage when they're actually buying a house, moving to the suburbs, realizing they need two vehicles because their two kids have soccer practice at opposite ends of Mississauga, and that kind of spending in aggregate is inflationary, and I think that sort of positive impact is going to continue to rise as this decade moves on, and the baby boomer retirement downward pressure is gradually petering out. I think this upward one's going to become more important. So not saying it's going to be hugely inflationary, but it's that downward pressure on inflation that's going to slowly soften. And I think you put those things together and you do have a recipe for rising inflation over this decade. I think we get a bit of a cyclical uptick in the near term, probably peters out after that. But then I think after that, we see a rise in inflation. So
interesting. There's a shape to that, I'm sure.
Yeah, we'll
come up with something.
Yeah. But yeah, I mean, honestly, we're still relatively constructive on the markets. We certainly think there's, at this point, with sort of some of the mania we've seen, there's probably higher risk of a correction in the near term, especially with bond yields rising. Honestly, like I've seen this before, and it's all the market's a funny animal, and it's because it's the aggregate of every investor. Like it's all of us put into this one.
Everybody's emotions, everybody's fear and greed, I suppose, right?
Yeah, and it piles in, and everybody's going in different directions and thinking different things, and that's what makes a market, and it's quite efficient. But it's what I always find really entertaining from a behavioral perspective is, you can have upward, like these bond yields, they've been moving up. They've been moving up for a few months now, so it's not new news. Maybe they're accelerating a little bit over the last week and a half, but they can keep marching along and have almost no impact. And then all of a sudden you can wake up one day and everybody's talking about bond yields and the impact on the market. And, all of a sudden the market goes from don't care to really care right now. And then you get sort of an adjustment. And I think that's probably what'll cause a bit of a correction in the near term. But beneath that, beyond that, we've got the economy doing a lot better. We've got kind of the end in the pandemic, I want to say, in sight. I don't know enough about pandemics to say that, but
I think
you can kind of see the end.
There is a light, there is a tunnel, there is a light. I think we were hoping it was a little brighter than maybe we're realizing it is now. An interesting article in The Economist this week says governments, because of their incredible role in supporting economies through this, it's not a matter of a pandemic with a beginning and an end. This is going to be an endemic, which is sort of a continuing perhaps thing. This is our annual flu shot, and it's got a COVID component and a variant component, and that will be truly interesting in terms of how governments can sustain this on a long-term basis.
Yeah, and what it looks like, and even on the healthcare side, I think it's going to be quite interesting.
Yeah, I think we'll put it out again. Does anyone have any questions? If you'd like to ask a question, and you can enter it into the chat or into the question and answer option. They're both available usually along the bottom of your toolbar. We're happy to take them. And
it's okay if there's no question. There's no.
Yeah.
It's not like Biz 20 where you get a mark. Yeah. You have to ask a question every class. But I would say if you do have a question even afterwards, feel free to email Bev, and she can ping myself or one member of the team thing as well. So
Brett, go ahead.
I've got 5 questions here that I can read off to you guys.
Oh, fantastic.
Yeah, so the first one is, I'm interested in knowing your opinion as to when you think the market value and the economy might resync together.
Yeah, so that, and I'm going to read into that this is the dilemma where everybody's kind of said, like, especially last year, like, how can we have this market that's, you know, making new all-time highs in the middle of a recession from an economic perspective? And the fact is, so there's two different aspects to this. Is one, the economy and the market 100% are connected. So although they can march in different directions for periods of time, and certainly that's what happened to a certain degree last year. But I think one of the other aspects that's worth noting is which market you're looking at, because I want to say, you know, there has been a massive movement in growth and mega caps and tech names that, you know, has been going on for much of the past decade that got really accelerated last year. And it got accelerated for, you know, a really good reason. You know, all of a sudden we were working from home, and to work and live from home, I need to buy things on Amazon. I don't have anything to do, so I'm going to watch a whole bunch of Netflix, and I'm going to work from home, so everybody's going to need one of these things that we're talking into right now. It's going to be connected to a cloud that's either hosted by Microsoft or Amazon. And, you know, all these confluence of things fed a pre-existing trend that accelerated it last year, which pushed a lot of the mega cap growth technology names to levels that, I mean, we'll probably look back in decades ahead and say, like, oh my God, why did we believe that could last forever? But
well, the whole big tech phenomenon, the FANGs, yeah, we've talked on that throughout the year. That's a temporary thing.
Yeah, I mean, and you know, don't get me wrong. Like, I think a lot of those companies have monopolistic pricing in an environment just because of the network effect. So there's reasons for it to be up there as well. But nonetheless, the change in behaviors and change in the market dynamics last year, and also the lowering of interest rates, which rewards growth companies more than value companies, really tilted things in favor of growth. And if you want to look at the performance of markets last year, it's really easy to see. You had, you know, the NASDAQ, which is primarily tech with some biotech, way up at the top. Underneath that, you had the S&P 500, which certainly has a very heavy tech weighting, technology weighting, and growth tilt. And then as you go down the list, you run into countries and indices like Canada. We're not growth oriented. I mean, we got some Shopify, but
Shopify, and that was distorting, but
yeah, absolutely. But it's, you know, in aggregate, we're more of a dividend value focused index.
Value, yeah.
If you look at Europe, which is much more economically sensitive, they were much lower. So, you know, even last year, it might have looked like on the surface, the market and the economy were moving in two separate directions. But no, it depended which market you looked at and how tilted that market was towards the economically sensitive versus the, you know, technology growth sensitive. And I think that's, you know, even if you look at emerging markets, it's the same thing. If you look within emerging markets, China has done exceptionally well because China is dominated by a handful of tech names, Alibaba, Tencent, a few others. If you look at broader emerging markets, which are much more economically sensitive, they did not do well. So, you know, we've got this sort of bifurcation in the market. But I think it did spread really far, and it will come back even in aggregate. You know, which way does that come back? Does that mean, you know, the growth names have to fall? Maybe, or do the value names catch up? I mean, that's the super optimistic view. That rarely works out in the markets, but
well, or a bit of both. Certainly
or both.
Yeah, the thing we noticed is you know, because we have favored value to be a little bit more conservative, you know, for our clients' sakes. They're either retired or actively planning for it. So we have always favored, while taking some growth opportunities, favored more of a value stance. And there's been quite a shift, a rotation into value started in November. Once the vaccine really came, you know, really into focus, that seemed that the markets realized, you know, we're not going to be doing this Netflix, Amazon thing forever. So the rest of the economy seems to now, or the rest of the companies in the value tilt seem to be showing, you know, the dividend companies, the banks are back and so forth.
And it's also worth noting, even within growth, and I think this is where it gets even a bit more complicated. It's skewed by the mega cap names as well. But once you dig beneath that, the valuations aren't nearly as pressed and far. But yeah, I agree. Like, I think one of the terminologies we used is Amazon is now pricing in a 3-year pandemic. Like, I don't know when this will change, but it will. I don't know if we'll go back to the malls the same way we did, but we probably will.
Yeah. Thanks for the question, Brett. Is there another one?
You bet. So this one's right up your alley, Craig. Why and how do regulators allow shorting of greater than 100% a share?
That's funny. Because when I was looking at it, I was racking my brain to figure out how that works. So shorting actually increases the number of shares outstanding in a company. It's a very convoluted way that it works, but it can, at the extremes, increase the number of shares that exist for a company. And the best bet is, whoever that was, email Bev, and we will send you a short paragraph example of how this happens. But essentially, even though if a company still has 100 shares outstanding in the marketplace due to shorting behavior, it can have 140 or 150 shares outstanding. And that's how the shorts can actually get up to 100% of the official outstanding shares.
And but don't try this at home.
Yeah, oh no, yeah, 100%. I mean, it was more of because honestly, like, I was sitting there going, how does that happen? But no, we had a quick conversation with one of our traders, and lo and behold, it's pretty straightforward how it happens. And
thanks for the question.
It's interesting. I don't know if the regulators will change it. I don't think they should, to be honest. I think people who short are help drive efficient markets. But we'll see. It didn't happen in GameStop. Go ahead, Brett.
Yeah, so the next question kind of has 3 questions inside it, but central banks say low rates till Q1 2023, yet 10-year yields are showing some life. What's your view on future rate increases? And are utilities set to decrease in value if rates post increase? And is it time to rotate out?
Yeah, and really that's where it comes down to. You've got the short end of the curve that the central banks can control all they want. And then you have, as you move out the yield curve to 5 years and 10 years, you get a yield that is more influenced by the economic data and the aggregate of what people are thinking, even beyond the influence of central bank bond buying, because that certainly influences the price a little bit as well. But I think it's the data does tend to trump the central banks the further out you get on the yield curve. So yeah, I firmly believe that the central banks are saying that they will probably stay locked on the short end for the overnight rate for as long as they possibly can. I think at some point, even they will stop saying that, because the really hard part is, and from economics 101, there's 7 ways for central banks to influence the monetary backdrop of the environment. Short-term interest rates, one; quantitative easing is another. There's a whole bunch of them, and then one of them is moral suasion, and that's just saying things. And we now, whenever they say things, the market just says there's no way they're lying. And I'm not saying they're lying, but what I'm saying is they can change what they're saying, and I think they'll probably end up changing sooner rather than later. But for now, there's no cost in them saying that we're going to leave short-term rates the same for 2 years. And I think that's probably the right thing to say, because it'll give people more confidence and sort of help this economic recovery. But yeah, longer term, longer yields are reacting to the improving economic data. That's the risk that those keep moving up. And talking about cyclical yield and interest rate sensitives, which we sort of touched on earlier, yeah, 100%. I think utilities are probably one of the areas that are more at risk. Those are utilities, gold, as we've clearly seen, telcos, real estate. Those are the sectors that are more sensitive to change in bond yields. And so if those bond yields do continue to go up, that will continue to weigh on those areas. within our dividend mandates, we are much more constructive on some of the industrials, some of the materials. It's hard to find yield in there, but you still can. And then the banks as well.
Financials, yeah.
Banks and financials, yeah.
Yeah. Okay. Brett, if we could take one more question and then we'll wrap up and get everyone on their way. Is there another question you want to put through for Craig?
Yeah, one more. So is gold no longer a store of value? Threats of inflation increasing, yet gold on the decline. Have people really moved over to crypto for store of value?
Yeah, no. And so, this might happen to Bitcoin at some point as well. But right now, Bitcoin's in a speculative bubble. There's no question about it. I'm not saying it's going to go down, but it's that's the kind of behavior it's in. And the interesting thing about gold, and this is why I think it's dangerous to be a gold bug all the time or love gold all the time, because gold changes what it is from time to time. So absolutely, one of the things that gold is quite often is a defensive tool against inflation. And 100%, it spends periods where it is that. It isn't that right now. It spends periods when it's a hedge against a falling US dollar. It is not that right now either. It spends time where it is a speculative asset. It was that in 2011. It's not that right now, obviously. What's driving gold right now, and I think, there's always all of these factors drive gold all the time. It's just which one's more important. Right now, gold is being driven by nominal yields. And because nominal yields are rising, gold is falling. And it is pretty straightforward. That's what's going on. Now, gold really reacts to real yields, and that's nominal yields minus inflation. And because inflation has barely picked up because of rents and other factors being still deflationary, you've got rising nominal yields, but inflation has stayed in the basement. And that's a bad combination for gold. What we believe is going to happen is in the coming quarters or months, this inflationary data is actually going to start rising as well. And when that happens, I think it's going to have it's going to be positive again for gold, because that's going to start to bring the real yields back down. But right now we're sort of in that painful, awkward period where nominal yields rise first before the inflation starts to pick up. And that's negative for gold. No, I don't think it's going away. It's too big. And even though crypto's gotten a lot easier to trade, crypto, I think, fits into the real asset bucket. But again, it probably has some early volatility to sort of work its way through in its process, which could mean a lot of money for people, or it could damage a lot of money for people. Who knows?
Yeah, it depends if you know what you're doing, I guess, right?
No, even if you know what you're doing, it doesn't matter.
Yeah.
It could really.
It's that volatile.
Yeah, and it's a new asset, right? Like, does it get regulated all of a sudden? Like, that would change its valuation overnight? Does other aspects creep into it? Do companies continue to put more money into it now that there's easier ways to buy it? Does that put more upward pressure into it? I mean, all these things pile into it, and so it is a speculative bubble. I don't know if it's still early in the bubble phase or late.
Right.
But
well, you guys have a very good piece on speculative bubbles that I've shared. We did an event on medical marijuana a couple of years ago, just to caution people, this is a speculative bubble. And, you could trace exactly where we were at when regulation comes in and technology gets applied. And so there's more room to run to see how the crypto thing works out, I guess. Yeah. I want to thank everyone. Those were great questions. I'm impressed with the insight and thought. So thank you for joining us and for your questions. And Craig, I do want to mention your resources from your team are excellent. Just in case anybody's not aware and they want to stay more informed these days, you have the daily launch pad, which is available through our online access. And that's something that I certainly give a glance every day, and I never miss the diversion. That's always fun. And there's, of course, the weekly ethos, which is a more sort of expansive piece with a particular theme. There you've had some excellent themes. So if anyone is interested in getting signed up for those, let me know or connect with the team and we'll get that set up for you. I think there's a couple key points, just that point about the uncertainty and the role of the media, as you said, basically bad news sells. So let's always be mindful. What you read in the media is usually magnified to some degree. There's some truth to it, but it's always going to have a tilt on it. So before you get concerned, emotional, scared, clients have been wonderful. We've ridden through this whole journey together. If you ever have questions or are worried, just get in touch. Let's talk it through. But bad news sells, and there are some good things happening with the vaccines and with society. There's a lot of silver linings that we've all experienced through COVID, and we'll get through it. I guess the thing I think of is hope for the worst, hope for the best, and plan for the worst. And know that we're here to continue oversight on your portfolio and position you in the best way that we can, given what we feel is coming ahead. So next in our Life Well speaker series, I'll just give a heads up in March that we're going to be joined by Michelle Pembry, personal trainer, because I know if you're like me, in your new world in the house, Craig, are you exercising, working out? Do you miss the gym? I guess it wasn't open anyways, I suppose, right?
We have a full gym in the basement, so
okay.
We're okay.
So sometimes we have full gym, sometimes we have a can of peas or a couple weights or a stretchy band. Michelle's going to help us kind of get over this cabin fever, because I think a lot of us need a little help and focus and direction and how to stay active, which is a little too early to go jogging just yet. So
there's always shoveling though.
Yes. Make sure if you're getting up there, let's make sure we, stretch before, because don't want any heart attacks out there. So it's Fitness Over 50 next month on our Life Wealth speaker series. And we'll get word on the details for that event sort of mid-March coming up. And I think that's it. There are some deadlines coming up for clients to be aware of. I sent a newsletter out by video on I think January 31st. I'm going to send it again next week with some key highlights, because we want you to be aware of RSP deadlines and tax filing kind of timelines. In the meantime, Craig, thanks again, and Brett, thanks for your help. And to everybody, stay safe, stay healthy, have a good day and a good weekend, and know that, as always, the team is here for you anytime you need resources, and we'll be reaching out to talk soon. So thanks again, Craig. See you next time for more coffee.
Sounds good.
Okay.
Thanks,
Bye,
everyone.
everyone.
Bye.
Thanks.